session on quantitative research methods in management. This session will be delivered by Professor Joshi Jacob, esteemed professor at IIM Ahmedabad. Professor Jacob specializes in finance and accounting and is a distinguished scholar in the field of financial markets and corporate finance. He holds a fellowship in management at PM from the Indian Institute of Management, Lucknow. His teaching portfolio spans across doctoral, MBA and executive programs where he teaches courses such as corporate finance, valuation of firms, behavioral finance, new venture financing, empirical asset pricing and factor pricing, and smart beta investing, among others. Professor Jacob's research expertise lies in the pricing of financial assets, behavioral influences on asset returns, corporate finance in emerging markets, volatility and market in microstructure, and systematic risk factors in Indian financial markets. His work has contributed valuable insights into areas such as IPO underpricing, idiosyncratic volatility, and market efficiency. He is actively engaged with the academic community as an ad hoc referee for leading finance and accounting journals, a core committee member of the JAF India Symposium, and a member of the editorial board of the Indian Journal of Accounting Research. We are deeply honored to have Professor Jacob with us today, bringing the wealth of knowledge and expertise to this event. Please join me in welcoming Professor Jacob to the stage.
Good morning. Thank you for the kind introductions. And it's quite exciting to be here in Amritsar. I think this is the first time I'm in Punjab, though one has been reading about it for the last 4 decades, one form or the other. It's a great pleasure meeting and exchanging some thoughts on quantitative research in finance. Before we start, I want to lay down what I would cover. And in that sense, I just want to very quickly get a sense what you would expect me to cover out of this. I'm sure that I can't really read everything that you might actually think this would cover, because all of us come from some tradition in terms of what our exposure is. So I'll just start here. Can someone speak up? What do you think you would expect out of this session? Yeah. You can be speaking.
Quantitative research methods which are well accepted by publishers.
Okay. And all right, what do you mean by that? Do you really focus on things like machine learning, AI, and things of that kind? I don't have any of this. I have quantitative methods, but which are more conventional in nature. All right. Someone here?
OLS or 2SLS kind of.
Sorry?
OLS or 2SLS kind of stuff.
Okay. OLS or 2SLS kind of approach. Yeah, some bit of that is, yeah. And any PGP students, someone said these are some master students on in the class, yeah. What would you like to hear from this session?
Basically, how the quantitative methods are used in the research and how they are translated numbers into the reality.
Right. Okay. So you came to know, how quantitative research is allowing you to draw certain insights about practice and what could really be that practice influencing certain choices that managers make. Right? Anyone else? Okay. What I will try and do is not a amalgam of these 3 things, but I thought, anyway, all choices are being made based on what you have done and what you think your perspective is. I would like to cover 3 postures. Posture 1 is about certain problems and the flavor of those problems that you could explore, which could really leave impact in practice and understanding of the world. That's one piece that I will try and do. The second is, I would say, some flavor of the data that is available and the limitations of the data that actually gives. And the third is some exposure to methodology, not in great depth, but kind of a smattering of that. Because anything like a workshop where data is to be handled, I think methods would really need a chat GPT plus treatment. So therefore, an open classroom like this where I wouldn't know your background, where you don't really have the data with you, it's a little hard to perceive those problems. Right? Okay. So that's the promise that we start with. We know that all of us start our career. When we talk to managers in corporate, they all say that, okay, when do I start? When I start my career in Excel. Then gradually your career moves from Excel to PowerPoint. And then PowerPoint to really sending some emails to your juniors and your team. And then a little later, you're not sending those mails. You're actually now responsible for only messaging, hand waving, giving leadership talks, and then you're become a CEO, right? There is an equal transition for researchers in the academy. When we all begin our financial academic career, we all say, oh, what are you doing? I'm doing volatility modeling with high frequency data. Maybe that's what you would start with. Oh, I have this data, it is really very hard to model, it's very heavy. And what did you do? Oh, I've actually improved the forecast error by some, X percentage. That's what you would really start your career with. And at that moment, like me, and I'm sure that all of us have that journey, or starting that journey, at that moment if someone comes and asks you, what is the significance of this for any practice? That will surprise us. Very little clue that we have. We are trying to still make sense of that at that moment, right? So therefore, what I meant to say is, then you find that, did I start with volatility? It is a very unappealing, crude, hard to different problem. You don't want to work on that. You move into something more applied. Oh, I want to go into asset pricing. Not volatility, not econometrics, not really methods, but something more applied and clear. Then you find that financial markets, I'm really saying that, expected returns are driven by a new risk factor. And this is the dimension that I brought out. Has anyone seen asset pricing dimensions? No one has seen it. Has anyone touched it? No. Has anyone felt it? Not really. So therefore, then we say, I want to really deal with problems that actually touches people. You move to corporate finance, you talk about decision making, what is the choice that managers are making, what is strategy. So all of us go through what I call as a career gradient. We all start from a very abstract, isolated, hard to apply problem, but hardly that would make a lot of sense for a wider audience that you want to grab attention of. So you really gradually elevate your pitch, and then you really become, all of us finance people start with econometrics and ends up in strategy. The reason for that is you want to appeal to a broader set of people, right? So what I will try and do here is that I present three problems that I have actually taken up as research. And when we actually carried out the initial research, what was our thinking and how it really evolved over time. We know that in research, when you write your first draft, until that time, everything is in your hands. But once you write that, there are many, then your judgment is not based on what you have, not under your control, but everything is in someone else's control. It could be reviewers, it could be audience, it could be anyone else, right? So I want to really a little bit give you that flavor of that problem. That's the idea that I thought I will do in this session. I start with my first problem. Very recently, we published a paper in the journal called Journal of Corporate Finance. This is actually located in what we call as in the corporate finance domain. We know that companies, every one of us are grappling with, managers tend to really know a lot more than investors about what is the likely future prospects of the firm. And it could well be that the future is not really so bright. But unfortunately, investors can't really read the manager's mind for one reason, that they don't know as much as managers. managers know. That is an easier problem to deal with. You can ask questions, you can have an analyst call, you can ferret out more information from the managers and figure out, oh, if this business is going to do well or not. Right, here is OpenAI. Okay, I've developed the GPT engine. Tell us 20 applications which can help you generate revenue out of that. Yeah, you can keep quizzing them and get more information onto the market, then get that price in the market. But unfortunately, quite often, we often say that, oh, what is the big challenge with ChatGPT? If you know what questions to ask, you have reasonable answers. But what's the challenge that everyone is going to face in a while from now? You don't know what are the questions to ask. So unless, it will soon reach a point, tell us the questions. If you have a question, there is an answer for that. But I don't know what question to ask. So quite often in corporate situations, unless managers voluntarily disclose what they think is going to be the future of the firm, it is really very hard for the investors to really figure that out. And worse, managers can really give you misleading ways of how their firm will evolve to be. Tell me which firm want to really say that next year my expansion plans are just worth 1 crore. Rather they would add 5 zeros to that and say that, oh, I'm going to really do capex of 1 lakh crore, right? So therefore there is a lot of misleading information that can also come. Therefore, we all know that the world has to evolve a device. What? A device by which managers can communicate to the rest of the world meaningfully so that the world understands what you are out to do. It will help you price your firm better. If you know that you're going to really do very well, capex expansion, margin expansion, you're really going to make your firm move to the next orbit, you should actually be able to communicate it. But unfortunately, it is really very hard to reliably communicate that because everyone has an incentive to lie. So what is the fundamental problem? You have to distinguish lies from those who are lying. The liars should be caught compared to those who are really willing to tell the truth. But unfortunately, voices are many where we can distinguish those who are proclivity to lie from those who are telling the truth about their firm. This is where in one of the basic finance concepts we are coming, that is called signaling. Signaling reads that, okay, the quality of the signal should be inversely proportional to. There is a basic signaling theory by Michael Stens, which says that if someone says my firm is going to grow very high and going to outpace the rest of the competitors, the cost of making that statement should be inversely proportional to the quality of the firm. Meaning a manager who is really very sure that he is going to deliver that, even my high level task force resources our firm has, the cost of that making that statement is much lower for that firm compared to a firm with very low, very poor quality team, poor resources, whatever else that you can imagine. That's the basic idea of signaling, which is why we say that signaling is equal to the quality of the signal can be believed provided the cost of making the signal is inversely proportional to the quality. Correct? High quality means low cost. I'll just put an example since this is a general crowd. If you think about CV from IIM Amritsar, is actually being judged as a quality of your employability compared to someone else who is actually sending the CV from a non-IIM institution. Why is that an IIM Amritsar candidate's CV is considered better? It can be believed so because the cost of producing that CV is inversely high for some, or disproportionately high for someone who is from another college, right? So therefore, one of the common such signals produced by companies to communicate what are they worth is called a buyback. A buyback is an idea that, okay, fine, here are shares of the company, is being priced at X rupees. You want to buy those shares back and give rewards back to the investors. In the process, you're buying shares, you're giving money back to the investors. And quite often this buyback could really happen at a premium compared to market price. Okay. If you are worth priced at 100 rupees per share and you are being given 105 rupees by the company to buy the same share from the market, what is our reading of the situation? The company ought to be worth 105, which is where the manager is really willing to buy it at 105 rupees as opposed to 100 rupees, which is the price in the market. A reasonable market should really get the sense that, oh, it is worth 105, which is why the insiders are willing to buy it at 105. And tell me which manager would be willing to really buy it at 105 if you have bought it and the share price tanks to 95. Why? Because what you worth is 105 worth, but you are actually, if the price goes to 95, you are going to damage yourself. Therefore, that becomes a credible signal. Because the manager who is actually willing to quote a higher price should be someone who truly believes that it is worth that much. Otherwise, you will not buy it. Now, to really execute this buyback, there are two modes being widely deployed by corporate around the world. The first mode is actually called an open market buyback, which simply means that what? I announce my intention to buy back. And then as and when things work out, if the market prices remain subdued, you will go and buy back, otherwise you don't. The other is called a tender buyback. A tender buyback is one where you would actually say that, oh, share price currently is 100, you will buy that back at 120 rupees and you commit. So the key difference, there are several differences, but I just highlight on one. The key difference between an open market buyback and a tender buyback is the commitment. Tender buyback is a commitment to buy back shares from the market at an agreed price, no matter what happens tomorrow. Imagine Donald Trump got elected and he changes the entire rules of the game in the world, and then the share price of the company could be badly affected because you got a tariff war against you. You thought your share price is 100, but right now it is 80. You would want to go back on your commitment to buy back, right? That's not possible in a tender buyback. In market-driven buyback, you can do that. There is no challenge. You agree to buy, but there is no commitment that you have to give. Then came an interesting resolution and regulation in India, which said, oh, a lot of companies in India announced the buyback, but they hardly seem to fulfill their commitment. When companies announce the buyback, the managers actually want to really tell the world that probably they are worth a lot more than the market because, and therefore the market prices show a positive response around it. But the company then forgets all that and doesn't really buy back anything later. So this is a particular challenge the regulator feels lead to lying. Okay. Therefore, in August 2013, they brought something called a minimum buyback regime, which simply meant that if you have announced a buyback, you should really buy back 50% of the announced amount. You can buy it back at your leisure in the agreed window of 1 year, but you have to really fulfill the 50% minimum threshold that you should set. Our thinking was, as researchers, this is a kind of hybridization of the buyback methods, because on one hand you have the tender buyback where you are compelled to buy back. On the other hand, you have the open market buyback where you have freedom to buy back. And the 50% threshold which is being mandated makes it, somewhere between the two. Therefore, the curiosity was, would it really lead to less misleading buyback announcements? Implying if you had actually the intention to buy back, thinking that your firm is going to do very well and your future is bright, are you more likely to announce buybacks on that motivation rather than to mislead and have a temporary impact on the prices? This is the ideal research question that one should take up. So we thought, minimum buyback is a unique experience in the world and therefore something which is really worth pursuing. And we published it, but that's what the fast forward is. But tell me if I were to, or you were to really look at this problem. We are now going to talk about, okay, here is a context in which we want to examine how minimum buyback rule has changed the nature of the firm that comes to buyback. Now, of course, for any great research to work out, there are three ingredients, right? One is you should have a suitable data where you can really demonstrate that this is true. One. Okay? Once you get any suitable data, then the second question is you need to really have a sense of what are the questions that I'm going to ask. To really say that firms that are buying back now are those which are actually more reliable, having brighter prospects, you need to have the right questions to ask them. The third is, whatever you may actually say in any data that you would actually test, you may get some results. But we know that the same results could be brought about by something else. I'll just funnily use an example. Let's say the rooster makes the alarm at 5 o'clock and then you see the sun rising in the east. You should not really think that therefore the rooster is the one which makes the sun to rise, right? The same problem that we will have when you run regressions and so on. You find that the data tells you this is happening, but is it really happening because the rooster is making the alarm? The answer is no. So those are the challenges that we will have. Of course, I would like to take you through that journey, what challenges we face, how did the world perceive it, and how did we really change it. One, we know that luckily for this research, we had a lot of theoretical frameworks available, right? Because signaling is a non-problem. And we know that any signal where the cost is higher, that signal will be perceived more reliably. Because there is theory going on all the time to help us. So therefore, fundamental argument that minimum buyback is a cost that you are adding to buyback, and therefore it will improve your outcomes is something not very difficult to argue. Where the challenge was? The challenge was in real data. Tell me what is the ideal data? Any quick response? What is the ideal data required for this analysis? Yeah.
Normally distributed data.
And of what?
Anything above 300.
Anything about?
Above 300 data.
When you say data, what is your output? What is your variable that data that you want? Stock prices. How will stock prices help you? Okay, anyone else?
Firms which are doing buyback before the rule and after the rule passed.
Okay, one way to think about this. What if I had the same firm buying back in the regime prior to August 2013, which is necessarily without the minimum buyback commitment, and the same firm coming back and buying back post 2013 August? We can say that, oh, look at it, the context that is motivating the firm to do the buyback earlier is shaky and looks shaky, and the context in which post 2013 you are doing the buyback seems to be very strongly cemented by a fundamental shift in the firm. Okay. Ideally, we should actually have ideally a set of firms buying back under the prior regime and a set of firms buying back under the new regime. But do we have such data? One, you know that buyback is more episodical and infrequent than anything else in the first place. Therefore, you wouldn't really get the same firm buying back in both instances. That's one challenge that you would face. And more alarmingly, what you would find is there aren't enough firms that are buying back in India. The total number of observations that you have is only 183. Firms bought back after this change in the rule. Of course, prior to that also the numbers are not really very large. What is the advantage of having larger numbers? All of us know that the standard errors should be much lower in the estimation. We know that the n would really matter because sigma by root n. But if you do in high frequency data any work, everything seems to be statistically significant. Why? Because the n is too large. Everything is going to work there statistically. But none of that would actually work here because the data observations are actually very few to begin with. So we found that the overall population of buybacks in India is quite small. Okay. And particularly so after the minimum buyback regime is announced. Is that expected? Expected, right? Why? Because we have made the cost of the buyback more harder. There are fewer firms that will make the announcement. Okay? So two problems. Third, and then came COVID-19. So by March 2020, by March 11, 2020, we know that the World Health Organization announced the pandemic, right? What happened is immediately on COVID hitting the market prices went down by 40% in the world. And Indian market was no exception. We got badly corrected. At that moment, a lot of companies announced buyback. And that's a different motivation altogether. Therefore, your data is curtailed by almost like March 2020. Now tell me if you have these issues which are surrounding you, you have overall much lower number of observations, fewer observations post this 2008 August regime change, and you have to stop your data in 2019 December. You are sort of hamstrung on all sides in terms of your availability to really doing a lot of stuff. Number one. Number two. Indian market is not. Buyback in India is something launched in 1997. Right? And why would the world be so excited about research out of India on buyback changes? What will be your quick response? You look at all this ugly reality, you can say that I'll give up at this moment, it doesn't look like anyone will actually be able to work on this problem. Tell me one factor that you will have your faith on. What is the first question as a researcher you will ask? Is this experiment very unique in the world? The answer is yes. Okay. And I'll tell you another experiment which is very unique, which researchers can now take up. What is the further experiment that we did on buyback in India? We have actually now restricted open market buybacks completely. We have phased them out. By 2025 March, we say no open market buyback. What is the challenge of this? Again, I want to put it in broader perspective. Unless we get a broader perspective of the questions what we are asking, we don't really have a good sense. What are we saying? If a firm has a very unique, specific information about what it is really going to work in future, there are two ways you can deal with that. One is to really make more and more announcements. Do analyst calls. Really give a lot more disclosure. But what is the challenge of that? Market can't distinguish between lies and true promises. And what is it there? Therefore, what is the alternative? One is to voice, the other is to buyback. So when you really restrict buyback and make it costly, what happens is the choice between voice and buyback actually gets skewed in favor of voices. So this problem then you can really sort of broaden the appeal by saying that, okay, look at it, in the choice between voice and buyback, India has made a certain choice, and that choice is to make open market buybacks more expensive. Is that something which is going to really leave lessons for the rest of the world? You would see, and we have seen ourselves, that there were really some abuse of the buybacks. There could be misleading buyback announcements and not following through buybacks. Second is, you would really want to buy back and show lower number of shares outstanding and therefore higher EPS and so on. Right? So therefore what? The world would be curious to know that whether our experiment is working. So we have a lot of faith. This would actually have some attention of the world. But the challenge would be to really, how do I really use that in the data? Right? Now, one thing that we did, when your data is sparse, estimation becomes hard. What is one way to really still keep everyone interested, or everyone would be sort of willing to take your research seriously? There is a lot of limitation in dealing with the data, which I will talk about. What can you do? what if we can really draw some theory, right? The advantages, as I said, this is a classical field in which a lot of information is already around what will be the behavior of different signals and what will signals, how will characterization of signals will change if you were to really move one lever or the other. So what we did is we actually used the basic signaling theory and then asked this question, oh yeah, there were models already which actually examined what is the fundamental problem? The fundamental problem is, okay, let's ask here. If you were to really stitch up a theory about buyback, what will be the fundamental question that you're going to explore? What should that theory tell you? What is the market's problem? Market's problem is to separate between good and bad firms. And is it an announcement as a signal of a good firm? Or is it an announcement that it is actually a bad firm which is making the announcement? Therefore, your ability to distinguish between good quality and bad quality firms should be higher after announcement under a minimum buyback criteria. In fact, going back in classical corporate finance theory, we already know that there are problems of this kind which are being looked at. So what we did is there was a basic signaling theory which said under open market buyback conditions, which without really any compulsion, right? It is harder to distinguish between good and bad firms unless there is a commitment of buyback. So we took that theory and then this is a game theoretic model. What we did is we actually extended that model by injecting only one thing. If I just use one phrase from there. If theta is the amount of buyback that was promised, we say that theta by 2 is minimum, right? And then now let's solve the model, alright? All the grammar that is required to solve the model is already available in all those other theories which have been built, and particularly there is a paper by Oded that actually just does a full characterization of the market. So what we did is we actually took theta by 2 or gamma by 2, whichever form you look at, as the minimum buyback criteria and try to really argue under different price conditions, do the market distinguish the good firm better from the bad firms? And of course, what do we mean by distinguish between the two? Distinguish would mean what? Oh, here is a firm that comes to announce the open market buyback. And the market has an inherent sense now with a minimum buyback criteria who will announce it and who will not. And how much will be bought back and how much less will be bought back or more will be bought back. That can really give you signals about the underlying quality. If you know that under the new regime which is coming, you know that open market buyback has become more credible. If a firm makes an announcement, what do we mean by separation? Separation means that the price difference on reaction should be really distinctly clear between the good and the bad firm. So therefore, theoretically what we found under a pure game theoretic approach, that the difference between the good firm and bad firm's price response on announcement of the buyback will be wider under the minimum buyback criteria rather than without it. That's the first thing that we've actually sort of gotten forward. Now, tell me, how does theory help?
Some concept maybe kind of helps us to give us a lens to really figure out what
The reason why theory was, very good. She's saying that, okay, that gives you a lens to hypothesize. It really provides you a guideline, what do I draw as I would expect out of the data, right? And mind it, without the theory it would have been much harder for us. Why? What is one big difference that will happen? Is that, okay, the announcing sample will be very different between pre-August 2013 and post-August 2013, right? Therefore, since you don't really have the same firm A coming under that regime and under the new regime, it is difficult to, because the population itself has changed between the two. Therefore, if you have a theory, it is a little more convincing to the rest of the world. Oh yeah, this is the expectation that you have in terms of the baseline shift. So we could really carefully orchestrate that. Okay, we would expect greater separation. Now, nice, great. You got the theory in place. There are 4 predictions out of the theory. I'm not really going to spend time on all of them. Now, tell me, how do you translate this into empirical questions? What empirical questions would you ask? And keep in your mind you have the data limitation that is there. Question 1, fairly simple. Is the market response to buyback announcements significantly higher under the new regime compared to the earlier regime? That question is very evident, right? And that would require of course I have to use some language of finance. That would require you to talk about cumulative abnormal returns or abnormal returns on announcement. That's the language that we use. How much unexpected movement is there in the stock price on announcement of the buyback? That is easy to deal with. What else? So therefore what? Market has really perceived the buyback announcement to be a lot more positive than before with the minimum buyback criteria. What else will you look at? What is your fundamental question? Your fundamental question is, has firms is there a shift in the universe of firms announcing buyback to greater quality? And are managers doing that under the assumption of their firms really outdoing the rest in the future? If that is true, what else would you expect? Oh, not only that, the market prices respond very good. What else? If the market is responding, reading this as a clear signal of their improved performance in future, what should also you expect? The operating performance of the firms in future to be improved or elevated compared to the rest of the group. Therefore, that would require us to examine the actual outcomes of the firm, let's say something like ROA, ROI, adjusted performance. In terms of real efficiency of the firm, you would actually see a bump up. But what is the challenge that you would have? For any imagine here's a manager who thought I'm really going to undertake a lot of capex, and the capex to follow through, for you to execute, to really have an impact is going to really take long time. The challenge for us was, if we were to do it, 2019 buyback probably will have to really trace them all the way another 3 years or 4 years. If we were to do that, the data that we ended up with was 80 observations. Right? So you can't take that route to really prove that operating performance is actually going to be improved. Which is also the reason why we actually sort of build the theoretical model. So lesson 1. If you're working in corporate data in India, the data available compared to anywhere else, like the market that you're competing with, is quite limited for any experiment that goes through. Therefore, if you have a theoretical model, it becomes a little easier for you to really orchestrate your problem, because otherwise for a lot of operations you wouldn't really get the stars that you're looking for. They're not there. You may actually see only 1 star last night. You may see 2 at the best, you wouldn't really see the 3 or the many that you're looking for. So if you can build a theoretical model, that is actually going to help you. And mind it, a lot of corporate finance problems that you would face, classical theory is available. You need to really build some handle on. Okay, first lesson. Second, the operating outcome that we wanted to really get, we couldn't really do that at all. And therefore, if you think you can't really get there, what else will you focus on? You will focus on more immediate outcomes, right? And you can't just rest everything just with market response. You'll have to really do something beyond that. What else can you pick up? Of course, I'm not saying that we were too bright to really foresee all these problems. A lot of them came with pushback. A lot of them came with questioning and reviewer pushback and participant response and so on. What else can you look at? Any? I don't know. I'm not forcing anyone to answer, but I'm just going to I know her a little better. What else can you look at apart from the initial market response? Okay, let me ask you. You are working in Microsoft, and you know that okay, AI is a phenomenal area in which you have put a lot of money, and you know that it's going to really work in your favor in future. The company announced a buyback, and things are now coming to head and crystallized. You are very sure of things working out. If you are an employee, would you sell your shares if the company announces a buyback, or would you actually, buy shares if things work out?
I will say no.
You won't sell your shares. Why not?
Because I know that, like I know the inside information, I'm already working there, and I might have the information that the firm is surely going to do better, and they are also selling the same situation now.
So therefore, insider trades, maybe you can really look at, how are the insider trades, is that flipping? Whereas under, without compulsion, without really minimum buyback criteria, where the employee is more likely to sell versus are they more likely to buy now? You can look at that. That's more immediate outcome that one can examine. So therefore, one is to really look at the market reaction, but we know that that's not really going to be very important, or not the only one. No one will accept that. Second was to really look at what we call insider trading. Is the insider trading shifting in a direction which is, attesting the faith in the firms far more than others? Right? We could find, luckily, some evidence of this. The other point is, we need to also look at if this is true, that firms are buying back because, they're very sure that things will work out far better in future. What else can you look at?
Promoter holding.
In India, unfortunately, that's not a test variable that you can use because promoters are anyway not part of open market buyback. Open market buyback is something which is directed at outside investors. Therefore, after the buyback, obviously promoter shares will go up. In fact, something that had been documented. So the point is, you have to really scan around the world to see what are the other postures or other questions that the people have actually tried to observe in the buyback field, which could behave differently under this. One such idea was something called a market timing. What is market timing? We know that once you announce a buyback, you get a window over which you can execute the buyback. It is, let's say, 1 year or 6 months. In the US, it's an open-ended window. In India, we have a restricted. During that window, you can decide to buy back. But when do firms are actually observed to buy back? When share prices are high or when share prices are low? When share prices are relatively low. So if the share prices are falling relatively low, you are essentially trying to gain from the fact that you have a sense of the intrinsic value. The market is cutting below that, opportunistically go and buy back. You will be better off compared to the average market price. This is coded as something called market timing. Firms are trying to buy back using the information advantage that they have. Effectively, they will end up paying little less than the market prices because they know exactly when the market prices are below the intrinsic value. If the motives that actually drive the buyback is shifting, would you expect a shift in this as well? Would you really expect that, okay, with minimum buyback criteria, those who are buying back because they are very sure that in the long run things are really going to work dramatically in their favor? Are they really so much will be as concerned about market timing gains? If I am going to buy back, then what is the most ideal to buy? If you think market is recognizing that you are buying back because you are really going to do much better in future, we can expect that the market prices may actually go very fast in future. Therefore, you won't really care so much about should I buy on Tuesday versus Wednesday. The difference would be 50 paise, 25 paise. What do you care? Grab a larger number of shares very quickly so that in the long run, that will deliver a lot of returns. Right? So therefore we expected that the market timing behavior would be significantly, or the motive to do timing of the market during the buyback window will be lower. Rather, what you would want is, you want the buyback to be executed pretty fast and do not really care about completing that over the entire window. So that would be the second point, to really sort of deal with the data challenges that we thought people could do. We find some results. The third, we know that there are two buyback modes. One is called the tender buyback, the other is called the open market buyback, and both of them are actually available to the firms. Now look at it. You have knocked off the flexibility that the firms have in executing the open market buyback and made tender buybacks more attractive, can we say? Or open market buyback at least more expensive. If you have made it more expensive, would you expect any other thing? I'm saying, the new open market buyback is actually somewhere between the old open market buyback and the tender buyback. Therefore what? Some firms may actually increasingly may favor tender buyback as opposed to market buyback. So what we found is, okay, fine, let's explore, is there a greater propensity for firms now to grab the the tender buyback as opposed to the open market buyback? So these were the 4 questions that we could really look at, because the long run model was out of choice. Now look at the dilemma of the researchers, as you would experience it for yourself, that if I were to wait for another 3 years, I know that I will actually get the operating market outcomes and things of that kind. But who knows, by then the problem will be taken up by someone else. So working in India, it is really very hard. You don't really have 2000 buybacks that are happening in a year, unlike US. So therefore, whatever little data that you get, very quickly try to build on that. So we actually worked on this problem. And mind it, our data is actually 180, 190, 60, 65. In many places, we were actually not getting the level of significance which is conventionally accepted as true. Okay. But what surprised us is that we presented this paper in multiple conferences, Financial Management Association main conference, European Financial Management Association, multiple places. And of course we were really very disappointed with the quality of the empirics that we had done, because the data would not really allow us to do a lot of things that we wanted to do. Alright. So we decided that we will not really shop it around in JFQA and the top tier journals, but the next year. The moment we sent it to JCF, we did not even get a review in the conventional form. We just got an annotated version saying that PDF annotation, these are some comments in terms of your language. We are okay with the paper. We are ready to take it, minor revision at first stage. We are quite surprised, purely because it went with the theory. It actually asked questions which are, more bounded to that problem that you have. Okay. So therefore, the point is, always you will actually have this persistent challenge if you are working with quantitative data in India and corporate finance. You have limited data to do it. Number of order of observations will be actually 1/5 of the US market. Therefore, what is important? The problem must be really very unique. And if you can really build a theory, that will help. And then, the rest of the dance that you do with the empirical data, you can choose to do it. Even if it's imperfect, the world will be okay with that. Alright, methodology, I wouldn't really say that anything very sophisticated we ran here. In fact, sophisticated methodology, why a lot of us agree that may help you pep up your posturing, it doesn't help you in building a credible story. What is the basic methodology in data and empirics that anyone expects? If you don't really find it in a simple regression model, then people would actually tend to disbelieve what you're actually making a claim about. The only thing that we threw was an industry fixed effect. I hope everyone is reasonably sure of using fixed effects in your regulations, right? Ideally, if you had the same firm appearing in the previous regime and under the change regulation, we could have really done a firm level fixed effects. If firm level fixed effects were actually being thrown, we could have really made a claim, holding everything else constant. The only thing that is changing regulation is look at it the same firm announcing different prices, of that is very different. But unfortunately, we couldn't really do that. The only thing that we could do was to really throw in a industry fixed effect. Nothing like that. Okay. How is the industry fixed effects any important? I want to really ask a question back in the class. How is the industry fixed effects helping or improving the odds of the problem? I'm sorry, I'm not forcing anyone. Do you think buybacks happen in waves? Where one industry is more likely to buy back at a particular point in time than the rest?
In the technology industry.
You can say that some of the problems that actually originates in one industry. Right, for example, okay, you talked about tariffs, garment industry may be very badly impacted, right? Or, pharma may be relatively better at this point of time, unimpacted by tariff. Or you look at it. Let's imagine that you really do what we call the sensitivity of all industries to Trump's Liberation Day tariffs on April 4th. You would find that, okay, relatively all of the country is impacted, but the impact is actually much greater for garments and, footwear and, there are a lot of industries in relatively small scale, unfortunately. And especially in this pharma related to that. You can say that therefore mispricing or underpricing is relatively episodical for industry. Therefore what? If you think, can you quantize the problem of fixed effects? The fixed effect, the help is, if you are thinking that post 2013, the buybacks that have come from more because it's all from one industry and they are all driven by an episodical underpricing. In that case, we can say that the industry fixed effect is actually holding the fact. If that has all come from predominantly one industry or within that industry, then that is taken care of. Right? So that's the only sophistication that we have to really do, but we can say that without much of any complication, we could really send this paper well. Right? Okay. So therefore, what we lack, of course I'm a graduate of IIM Lucknow and in 2007, we had almost no exposure to really writing theory. There were the PhD programs around the world. If you were to really use the quantitative data available in India, to deal with that is to really have some exposure to theory building. It could be game theoretic, it could be equilibrium theory building, but I think we have to have some level of exposure there. It can really come very handy in dealing with problems of this kind. Okay. I just stay back here. You want to know more about anything about this problem that I portrayed? I'll stay back if you have any questions or comments to make here.
What is this concept of difference in the number of companies which offer database and market before 2014?
Actually, if you go by very good observation that you have, the numbers. I mean, if you really do what we call as real feel, eyeball, the differences are not high at all. You don't really see a surge in the number of tender buybacks. Therefore, you can't really observe it with the naked eyes, nor you can feel it. Okay? So therefore, the only way you could really see that was to model a probability. What is the now? I mean, I'm very sure of where you're coming from. The actual differences are very limited. Therefore, what is the modeling challenge that we took up? We wanted to really see which of the firms are likely to do a tender buyback, has the characteristics that is influencing the choice of the tender buyback, has it been? So we try to really see, here is a firm, okay, which is actually, has has very little stock market liquidity. If you are actually having very little stock market liquidity, then we know that okay, executing an open market buyback may be more challenging, right? Because execution of the market buyback would actually need a lot of market liquidity. So therefore, are these firms more likely to do a tender buyback, or their likelihood has increased? So we have moved away from looking at has the numbers really changed, what explains that shift, to really there's a probability change. Simply because we don't really have the data, enough data to really be able to. So what you can say at the best based on our research is that has the nature of the firms that are actually accessing buyback, open market and tender has really shifted. There is some evidence of shift. That's what it is.
So it has done some work.
Sorry?
This introduction of minimum stuff has really done something.
Some work. So therefore, what is the policy level response I would give? The policy level response is that SEBI's choice to really restrict open market buyback by mandating minimum buyback as improved the signaling value of buybacks, which is why we have actually called it as the cheap talk in the market going down. Okay, now the four researchers who are working in this field, the question that we should take up now is that how is it that restriction of the open market buyback post March 2025 and the elimination of that is going to really make things different. Now I'll tell you where the challenge is. So I sit in the RMRC of SEBI, the Risk Management Review Committee. The challenge that I see is it's a very harsh decision. Why? Because see, look at it, here is Donald Trump who is in power. And he says on April 4th something, that Trump can't really remain sane more than 24 hours. So let's imagine here is a firm which I thought I'll get very badly hit due to the tariffs. And therefore, the market may really get scared about my firm. But I know that it is not really as bad because I can find other markets. I can really alternatively negotiate these contracts. I know that my customers are not as sensitive. Some of them can take the hit of the tariff and still buy my goods. Therefore, my impact is less. And therefore, you want to really portray to the rest of the world, you are actually a firm less impacted by the tariff compared to the rest of the group in the garment sector. So you announce a buyback. Let's say you announce a tender buyback. Open market buyback is eliminated by SEBI. What is the challenge that you face? Trump on another day can entirely change it. If the tender buyback requires a couple of months for it to really complete the legals and set the manager, execute it, you may be now really forced to do something which is not worth it. Therefore, what is the benefit of the open market buyback? It leaves you the flexibility. Therefore, some combination of open market buyback and tender buyback is required for markets to work. But unfortunately, the regulator has actually done an overreach and shut it down. Therefore, you may want to really go back and check, what is it really doing to the ability of firms to signal their value? That's an important question that is worth pursuing every day. Because in the choice between voice and buyback, you are actually shutting down one mode of buyback. That will actually expose so much significant risk. Is a question that we have to worry about. Okay. I'll just say that this is a very unique natural experiment that no other regulator has done, and therefore we thought we'll latch on to that, and we find that it improves the quality of the conversation between firms and investors. The credibility has been elevated. That's the outcome that we see. Okay. I move now to unless you have other questions, I move to a slightly different research where I'm awash with the data. Whereas we talked about 180 observations to really feed in, and then you look at for the control variables and so on, several firms drop out further, you will end up with 110, 108, 98 observations and so on. We dealt with that by adding theory and also really providing things where things will work out for us. This is about research on investor behavior. I have done several cases, but I'll just talk about two of them. We know that when we are dealing with the individual investors, they are creating choices. What do you think is the order of observations available in the market? Not in hundreds, not in thousands, but in many millions. Because we know that one day's trade data can be multi-millions, right? Therefore, you run anything, we know that we are actually likely to find. We can say that we have observed enough, and therefore any result out of that is actually credible, reliable, because we have observed that widely and copiously and in several instances. Now, therefore we can say that anything that involves investor data is actually very good. But what is the challenge? The challenge is SEBI is increasingly reluctant to give you that data. In fact, a lot of restrictions are in place right now. You know that you can really go and you can get that from NSA, but with a lot of caveats attached to that. Okay. So data is really, copious. You have a lot of tests and flexibilities that you have. Now, I have a question for the researchers. If phenomenal amount of quantity of data is available, what would the readers and reviewers expect? Would the quantitative models be rough and ready, or would they expect the quantitative models to be very refined? Very refined. Therefore, what happens is, you have very little data, you can really do rough and ready, and people will be happy grabbing it. If you have a lot of data, they would also expect your refinement to be that of higher order. This is the problem that we face. Now, there is an interesting twist to the whole schema here. This is a paper that got published in Journal of Banking and Finance. The problem that we are looking at is very simple. Okay, let's imagine you go to a football match and you watch out your favorite team. The match is divided into two halves. Team A plays very well in the first half but disappoints in the second half. Team B disappoints in the first half but exceedingly well in the second half. And you are now predicting the odds of this team doing well in the next match. And imagine that both terms' average performance is the same. Only difference is first half one was done well, second half the other team has done well. Which are you likely to forecasters likely to do better in the next match? The team 2 which is done well in the second half. The idea that we are picking up is that not all returns are equal, because returns are measured as the difference between point A and point B of the prices. But we know that the return track, you could really reach the same return. Let's say here are 2 points at the end of these 2 curves which are being joined, point A and point B. It is actually ending up with a positive return because the end point is a little higher than the other point, right? But the return can be reached in 2 pathways. One is like a up and down path, the other is like a down and up path. The down and up path is more like the team that actually played better in the second half, right? But the average performance is the same. We are raising this question. If the return trajectory is different, which is what we call as price path, then does it really lead to very different perceptions about investors holding or selling a stock? With the prime question being, we know that from another literature, which is called behavioral finance, there is something called over-extrapolative instincts of individuals, which says that individuals are more likely to forecast using the more recent observations, giving greater weight to that. Therefore, if you are observing greater upward trajectory for one stock in the recent past, you are likely to perceive it to be more optimistic than it truly is. That is what the over-extrapolation idea is. Therefore, we ask this question, having seen a price path, or rather, imagine 2 stocks, investors face the same return, but the return path is very different. Do they perceive different expectations for future, and therefore their selling proclivity is then different. This is why the paper is titled Price Path and Selling Propensity, or disposition as we call it. How do you dispose your shares off? When we started this research, what was the motivating background? The motivating background was, there were a lot of psychological experiments that had been done, okay, which says that I give you 2 different price paths and one up down, one down up. You seem to really rate the performance of the down up better than the up down, because there is some momentum that actually gets in your mind. The down up is really going to upward trend and the other is going to trend downwardly. This is the problem that we look at. So therefore experiments had shown that we wanted to pick it up in actual data. Now what is the first challenge that you face? You need to really get actual records of investments of individuals. Luckily back in 2015 the commodities market for the first one actually gave some data to us. But commodities market is futures data, right? I mean it is not really spot market that they are offering. They gave us some data and said, okay, you can really trace individuals where are they really selling. Are they selling more likely to sell when the contractors, recently downtrending? Okay. So that is where we began, but the challenge was, no one believes in Indian market data. I don't know whether you face that harsh reality, you research a paper somewhere else. For a unique problem, they are very happy. Okay, Indian regulator has only done this, minimum beta criteria, they are happy to take it. But you really look at an investor proclivity problem is interesting in literature, but they are saying, okay, futures market data, commodities, NCA, who has heard of this exchange? They are not interested. But I will give you so eventually what we did, I'll tell you first, fast forward, 4 years, we actually worked on a data set which is standard. There is this data set made available by Professor Terence Oddy. It is actually individual investor level data. And of course there is a whole lot of story in the past about how did he come across that data. In fact the story and the stuff is, he was traveling on a taxi close to his campus. And there happened to be a CD lying in CD. Do you understand a CD? A CD lying in the back seat. He picked it up and then he went and inserted in his computer. He could actually see that this is records of a set of investors on their trading left by a broker by mistake. He happened to come across this data. So and he could really get the identity of the broker whose data was there and whose investors were. So he called up the broker, he said, I have your data. The fact that I have your data is actually a breach of your legal obligations. Now you have two choices. You can really, I can really use this data and you will be responsible for the fiduciary breach. Alternatively, you can really give me license to or permit to really use this data in a limited way without exposing the individuals. The broker chose to really do the second because not that he was so much worried about the legal breach, but he was thinking that it might be some beautiful insights. So he permitted that to be used. We got hold of the same data from Professor Terence Oddy. Then we thought, okay, we have a standard set of investor data that is available. Not millions, tens of thousands of investors. And 3 years of their daily trading record we have. Problem will be very simple now. What is the problem? How is the problem very simple? We need to first measure the curvature of the path. If I know the curvature of the path, then we can say, oh, someone saying a more upcurvy path should actually be selling their stock with a greater propensity than those who see it elsewhere, right? So therefore convexity is the dependent variable. If I were to use the term convexity, is the dependent variable, what is the outcome variable? The selling propensity, right? Is the selling propensity being moved by that? Now if you do it in this ready and rough way, no one will expect it. This is why I am actually going to show you the sort of approach which we did. Therefore there are two methodological choices. First, how do you capture the curvature of the price path? There are two ways. One simplest way, that is now the world has accepted. I think wherever one should go to when you do a workshop, something should be written on the board, right? So we can say that okay. If this is a path here, this is like a down of path. If I take the average price level, let's say this is the average, and this is the midpoint. You can say that by comparing the midpoint and the average, you should be able to really get a sense of the curvature, right? If the midpoint is below the average, you can say it's a downtrending path. If the midpoint is above the curvature, you can say that, sorry, the other one is a down and up, the opposite is true for the up, right? That's one way. But we didn't really have this simple insight to begin with. I mean, a lot of good things happen in life after a lot of failure, right? Markets and mistakes are the best teachers. So we did not really have this insight. So what we did is actually something very complex. I don't know how many of you know there is something called prospect theory. Prospect theory says that the way in which you would really read anything is that losses are going to be punished, or in the value, the absolute change in value in the losses is far greater than with gains. So we thought a path is a series of returns, right? Path is a series of returns. As many as a number of days or 5 minutes, or we didn't really have high frequency data here, we only have daily data. So as long as the investor is holding the observations of the returns, we will actually apply the prospect theory to this with a weighting scheme to positive and negative returns, and also a time weighting. So there are two dimensions. One is distinguishing between positives and negatives, the other is to really do a time weighting. The time weighting that we chose was an exponential weighting. So therefore we got something like this, which we call as the TK rho or whatever, which is equivalent of a time weighting that we do over the time, so that we claimed that this is actually going to capture the way in which investors are going to read the price path in a behavioral lens. Why behavioral lens? If the losses occur in the recent past, then that is punished far more. If the losses occurred in more distant past, that is actually going to be punished less. However, if there are more losses than gains, then that will actually also have a lower value. This is what we actually framed the first proxy as. Of course, we then it has to be just to capture a curvature, so it has to be scale independent. So we actually did a scaling adjustment for all of this. This is what, and we got, if things were this good, that we could distinguish between clearly an up down and a down up price path. It's not really that nice. It's very ugly. A lot of shapes comes in between which are neither up down or down up. But empirically, then it became a challenging stuff. Okay, what we ended up with is finally we accepted this and published. But when we started with, we did not start with them this way. Of course, there are 100 rounds of questions on this kind of proxies which are very complex. The rest of it is not very difficult. I will just tell you, the model is fairly very complex. You can see how many fixed effects are being used. For what? Any estimation with individual level data need to really have a lot of saturation. I hope you understand the word saturation, right? Why? Because gone are the days in which you can say that I have a lot of explanatory variables, and therefore those explanatory variables are good control variables. You can't do that, particularly with this data. Tell me why is weekday fixed effects applied here? Take it. You are talking about an individual selling propensity as linked to the observed price path. If you are selling on Monday versus Friday, we know that there are non-propensity on more selling on some days of the week compared to the rest of the days. So the weekday effects will actually take care of any differences that you would observe in the choice of really having to sell on Friday versus Thursday versus Monday. If you think on an average, investors are selling on Friday, that also happens to be on days in which there is a marginal increase in the price path curvature, then that is actually bad. Why calendar month fixed effects? That's a much more easy to observe, right? Because we know that there is more selling that takes place in December, where you want to book your tax losses and buy back in Jan. Selling propensities are very different. Okay, year fixed effects. Understandable, because we know that 1997, 2001, 2008, there are years in which there are episodical selling that happens. We want to distinguish that. Expiry month fixed effects, okay, because this was actually originally worked with the futures market. Alright. Because whether it is actually going to expire in June, July, the contract, right, that would matter. When we ran with the actual data of parents or deal, we introduced investor fixed effects. Why? Can anyone simply give us a sense of why is it a must in any investor specific studies that you must actually include one? What are you bothered about? There is a lot of difference in the propensity of investors to take risk, hold risk and get off from risk. And the moment you are saying that okay, the investor's choice about selling or holding is strongly going to be impacted by the price curvature. Therefore, what should you control for? The difference in the investors is to, or the difference across the investors to take risk, hold, sell. Therefore, investor fixed effects will take care of anything. Gender, age, experience, anything that you can imagine, all of that was taken care of. So you have to really employ extremely saturated models. If you are really working in investor level data, everything has to have interactive fixed effects, only then people will actually take your results. Alright, so the point is, we learned two bad lessons here. One is that no one really tends to think that Indian market is something visible and reliable. Therefore, you can't really work this stuff on the investor level data from the Indian market unless you can prove that that market is like normal market, because we were actually holding the data of the commodities futures market, no one trusted us. If you are taking data from MSME, it is something that you can work out with. But high level of fixed effects are to be employed only then the data would actually be considered reliable for two reasons. One, heterogeneity across investors, trade time, assets are very high. Unless you control for all of that, people will not believe it. Second, results here can really become significant purely because of the N effect. The number of observations are far too high. You are talking about lakhs and lakhs of observations. Therefore, unless you have saturated fixed effects, it's not valid. Yeah.
So, would it make sense to report semi-saturated models also? In the sense that I won't add investor fixed effects, I report without investor fixed effects, and then I show with investor fixed effects.
No, the baseline itself should have minimum investor fixed effects. If you are using high frequency data, you can even think of investor day fixed effects. Because an investor choosing to really trade on a particular day could be really very different for the rest of the combinations. But if you don't have only fixed data, high frequency data, but only daily level data like what we have, you will have to do an investor week fixed effect or an investor month fixed effect, interactive fixed effect. Only then it would work. The baseline itself should be.
Would it have any theoretical value?
Sorry?
Would it have any theoretical value? If I show the difference when I put fixed effects for investors?
No, because the unobservables are too high, right? Because the observed and unobserved heterogeneities are far too high to not really have a saturated one. So baseline should be saturated. Okay, so therefore, now the challenge is, in this kind of work, then robustness tests that you require are fewer. In terms of your estimation, okay? Because the data is copious, you have actually saturated with all fixed effects. Year, month, investor, week, all that is done. Where is the robustness test then should come? What should be the robustness test be focused on? All the robustness tests in this kind of work, because your methods are reasonably reliable. Therefore, what would be the question that they would worry about? They would worry about the concept itself, right? The robustness should be for the proxy. Oh, you say curvature of the price path, and therefore, for instance, this is equivalent to convexity. It's like the second order of the time series, or you take an R square, you get this. Therefore, the question is, what you are observing? Fine, I believe in your empirics, but is it capturing some other phenomenon, right? Is it that the investor was actually seeing an up-down price bar, selling with greater propensity because he thought that it's likely to believe in something else, right? Therefore, your robustness test need to really run what else can be true. For example, what will come to your mind if you were to think about investor level studies? One is mean reversion. Okay, mean reversion means what? Something that went up, it has to come down. Something that actually went up, it has to, went down, it has to come up. But in this case, we can say mean reversion is diametrically opposite of our case. Because we are actually taking a convex price path. And if you are holding and less selling, then if they believed in mean reversion, they should actually sell more, right? So obviously that was running opposite of that. So we had to really run something like 8 phenomena we had to roll off. So investor level data, robustness is not in methodology, not in estimation, but it's in the phenomena. Okay. With that, I take you to I think it's till 12:35. I'll take 6 more minutes. I'll take you another work that we are currently doing. It's again a same data set, investor level data set. Our focal point is to really try and see something called upward mobility bias. It's not a phenomenon that is being examined in financial markets. I'll tell you what it is. Imagine here are 2 investors who are holding 3 stocks, A, B, C, same stocks. And imagine that they all started holding it from the same time. Then the return that they experience is the same. There is no difference between the 2. But let's imagine both investors have one common stock called the C, one called the ABC, the other called CDE. And the performance of the D and E stocks are very different. Therefore, what happens is, when the investor looks at the relative performance of the stocks in the portfolio, one investor who is holding ABC sees the stock which is really done exceedingly poor within the 3 stocks. Therefore, in his mind, the performance of that stock is the worst. And the other investor, let's say, is holding CDE, and he finds that the performance of the stock C is the best within this group. Therefore, he is actually thinking that in terms of the relative performance, the rank is number 1. In the other case, the rank is number 3. In fact, behavioral scientists had actually run a lot of experimental work to see how do people respond if they are shown an orderly set in terms of rank. For example, let's say here is a list of 5 students is being presented to someone, and they've been asked this question: which student would you think will improve better in future? What do you think is the answer generally? The student who is ranked very high or the student who is ranked low? Who will perform better? The student who is ranked relatively low. This is what we call as upward mobility bias. He's saying that, okay, oh yeah, here are people who are at the bottom of the income bracket, we would expect them to improve and be better than the rest. Therefore, if I were to really take another ranking a little down the road, that should turn out to be better. But what is a fallacy here? The fallacy is, it's a relative ranking, right? If you have 10 items for the 10th guy to really improve significantly, you not only need an absolute improvement in your performance, you need a relative improvement in your performance, right? Because the first ranked guy and the rest of the highly ranked entities will also try to improve their rank. So therefore, you need to be really better. You need to be better in the relative sense rather than in an absolute sense. So upward mobility bias reads us, you are substituting absolute improvement for relative improvement. And therefore, you think that the order of the ranks will change, but it will not change unless there is a quantum leap. Therefore, the issue that we are trying to look at this, we are again, trying to see whether is there an upward mobility bias reflected in the selling decisions of investors. What is the operational part? The operational part is fairly simple. Are investors likely to show more proclivity to sell a same stock if they are ranked relatively low in their portfolio compared to another individual in whose portfolio the rank stands high? This is very easy to examine. This is still under work under circulation rather than anything which is completed. Okay, I'll just show you how saturated the model is. I don't know whether you can see this. Trader fixed effects. Understandable, because traders have different proclivity across them in trading and selling and buying. Then we are saying there is a stock year-month fixed effect. What does that capture? We are saying that okay, a stock in a particular month of the year or year month may have different proclivity to sell. We know that there are several theories which will ground our observations in favor of that kind of a fixed effect. Momentum. We know that some stocks could be in momentum in a particular month, then gradually momentum gains out. We know that there are short-run returns and bonding and so on. Then there is return rank fixed effect. What does that mean? You know, for each rank, the selling propensity is different. What do we want to find out? What we want to find out is, we want to find out how will the selling propensity change if the rank of the stock is different between two portfolios, right? That's the kind of observation that we want to do. Trader day fixed effects, what is that? A trader on a particular day, does it really have a different propensity to sell or not? Therefore, unless we saturate our model with high level of fixed effects, which are called interactive fixed effects, we cannot claim any legitimacy in the results. That's what we have done in this paper. Alright. Of course, the sad reality is, despite all of this being thrown, and the statistics of this is very exciting, what do you think the question will be? The question is at the phenomenal level. What you call as rank-induced differences in their selling propensity, what else it can be driven by? They are saying, okay, is it a mean reversion? It can be, right? In this case, it can be a mean reversion. Why? Because if you think your stock is low ranked within the portfolio, then you are probably, that is all on account of poor performance of the stock related with the rest. You are expecting it to reverse and flip. All that can happen. Therefore, one way by which we have so far, now we have added something. We try to really look at what we call as a rank based on alphabets. The alphabetical order of the stock, we take the ticker symbol or the first word in the name of the stock, and we try to really see whether that kind of a rank leads to this kind of outcome. We find that a time invariant return unrelated ranking order is not really producing the same result where you show lower propensity to sell a stock which is lower rank and higher propensity to sell a stock which is occupying the higher rank. We don't see that in the alphabetical ranking. That's what we are holding on, but we are very sure that that is not going to satisfy the reviewer. Therefore, we need to really, we should actually just prove that, what we observe is only on account of this and not due to something else. Therefore, you'll have to really say what else A, B, C, D, E, Z, which can really potentially lead to the same outcome. Unless we rule out all of them, they will not be related. So that is the challenge that we are facing. So we can say that methodology has become very sophisticated, and econometrics now allow us to really use interactive fixed effects. Therefore, no one mistrusts anymore your estimation methods. They will ask for your data and code to supply it. They will be very happy. But questioning has come back only phenomenal level. Therefore, in the flip between the corporate finance and investor level studies, we can say in corporate finance you can get away with murder, provided your idea is relatively novel. In investor level data, we can say that data is actually has to be dealt with ultra sophistication. Then the question is coming back on actually ruling out the alternatives and the phenomena. So this is the kind of struggle that we go through as we are going through. I stop here in the interest of time. I think any questions or observations I think.
When we go for high level of saturation, is there a chance that we lose variance?
Absolutely. Rather the variance that you will explain will be very high, the coefficient value will keep keep shrinking because the extent to which your coefficient will explain, that will be very, very small.
Does the end go down because we are making it?
We want to say that this is what it is because of that, right? And for to really pin that down, the saturated models are the way to go. I guess, when there are no other questions, there are two sides. Either is everyone has understood everything that was being said, or no one has understood anything, either possibility is there. Between the two hypotheses, we can run an empirical test and see which will fall. But in the interest of time, let's go. Thank you.
Thank you, Professor Jacob, for a wonderful session. Now I would like to invite Professor Sameer K. Srivastava, Director at Amritsar, and Professor Jagriti Srivastava to felicitate Professor Jacob as a token of our appreciation and gratitude.
Thank you, Samir. It's a great pleasure to be with you listening in the audience. He was my senior at Lucknow.
With this, we conclude the formal proceedings for day 2. We wish all participants a productive, engaging and memorable day ahead. Thank you everyone for your attention, and we hope you continue to have an enriching experience at ICMM 2026. Lunch will be served from 20:30 p.m. to 1:30 p.m. Following lunch, all participants are requested to assemble at the academic block around 1:30 sharp, as the buses will depart promptly at 1:30 p.m. for the scheduled visit to the Atari-Wagah border. After the conclusion of Wagah border visit, participants are requested to gather at the designated meeting point around 6 p.m. for boarding the buses which will depart for the gala dinner at 6:15 p.m. In the unlikely event that anyone is unable to join the group for the bus departure, they may proceed directly to Sarap in Amritsar and are requested to reach the venue by 7 p.m. for the gala dinner. Thank you.